Okay, let's dive into something that feels both ancient and incredibly current today.
Sounds good.
We're doing a deep dive based on one specific source. It's the latest weekly newsletter from the Macro Butler. And the title is, well, pretty provocative. In chaos we trust. With gold we survive.
Yeah, definitely catches the eye.
So our mission really is to try and cut through some of the noise, make sense of this, economic fog a lot of people feel they're in, and specifically unpack this source's argument about gold. Why gold? Why now?
And maybe find a little bit of dark humor in it because, yeah, the alternative isn't great.
Exactly. So the source kicks off by framing 2025. It's not a recovery year, not really. It's described as a fog thick with the unknown.
Right. And they make this point that what investors are calling uncertainty, it might actually be closer to chaos, which is, fundamentally different.
And that distinction is key. They go back, way back, to draw a line between risk and uncertainty, based on Frank Knight's work.
Yeah, 1921, risk, uncertainty, and profit. Knight's big point was risk is measurable. You can calculate odds, run statistics, build models for it.
Okay, like knowing the odds of drawing a certain card.
Exactly. But uncertainty, Knight said that's radically distinct. You can't measure it. It laughs at statistics, mocks your forecasts. It's the genuinely unknowable stuff.
So not knowing the odds, maybe not even knowing if you're playing cards at all. And the source argues that real entrepreneurial success comes from navigating that space, not just taking calculated risks.
Precisely. It's about dealing with the incalculable. And then the source pivots to this critique of, well, modern economics.
What's the critique?
That they often just slap the label uncertainty on things because they're basically ignoring, 5,000 years of human history, ignoring clear cycles that don't quite fit the spreadsheets.
Yeah, I saw that. Pushing back on the idea their economy is just random noise needing constant government fixes, the sort of Marx or Keynesian view.
Right. They use this physics analogy that, Newton showed things aren't truly random. So the source kind of jokes. Either Newton was wrong or maybe your econ teacher was, blowing smoke.
Huh. So the core argument is cycles are real. People who understand them weren't surprised by recent events.
Exactly. It's the economists and politicians, in this view, who thought they could outsmart the cycle. And now, according to the source, the world's dealing with the fallout of ignoring those historical rhythms.
They bring up examples too, right? Historical figures.
Yeah, Arthur Burns, Fed chair when Bretton Woods collapsed, learned the hard way, apparently, that the business cycle always wins.
And Volcker?
Paul Volcker, too, famous for breaking inflation in the 80s. He also concluded the cycle's just relentless. The source mentions his observation about it running roughly every 7 years.
So for the source, this just blows up the whole idea that recessions are optional or that governments can always perfectly intervene. The cycle is king.
That's the framework they establish. Cycles and real, deep uncertainty.
Okay, so with that backdrop, the source then points to signals they see right now, confirming this more chaotic view. And they highlight a specific market event on a specific date, January 20th, 2025.
Right. The day the figure they call the disruptor-in-chief took office. And they note, on that exact day, something happened with the S&P to gold ratio.
What happened?
It broke below its 7-year moving average.
Okay, for people maybe not glued to charts, the moving average smooths things out, shows the long-term trend. So breaking below is significant.
According to the source, yes, very significant. Their read is blunt. The economy is bracing for impact.
Right.
Forget the soft landing narrative that Wall Street might be pushing.
And it wasn't just that one signal. They talk about policy uncertainty just soaring.
Yeah, they claim it actually shot past the levels seen even during the start of the previous administration, which, as the source dryly notes, is impressive.
What's driving that, according to them?
A big factor cited is this vague plan for reciprocal tariffs. The source suggests it might as well have been drafted on a cocktail napkin. Nobody knows the details, potential retaliation. It just breeds uncertainty.
And you can see this broader impact in indices, maybe.
They argue yes. The Economic Policy Uncertainty Index, they say, is flashing red. They paint this picture of newspapers just stuffed with words like economy, deficit, and White House, calling it a financial horror story in daily installments.
Grim picture. And all this uncertainty, especially around policy, leads the source to conclude, what about the U.S.'s global standing?
That it's shifting. Investors globally are starting to see the U.S. less as that reliable beacon of rule of law finance and more like, well, their words, an unreliable friend.
An unreliable friend who might change the rules suddenly. And the consequence of that perception,
is that smart money, savvy investors are quietly looking for the exits because they understand counterparty risk, the risk the other side won't deliver. And that risk applied to U.S. assets suddenly looks a lot higher in their view.
Which brings us neatly to the source champions in all this mess.
Exactly. The primary beneficiary they identify in this chaos and uncertainty,
Oh, yeah.
physical gold.
Right. Old, reliable gold. The source paints it as almost aloof. It doesn't care about trade tantrums or legislative gridlock or bad press conferences.
Yeah, uncertainty and geopolitical drama. The source says that's gold's spa day. It kind of thrives when everything else is shaky.
And this ties into their argument that some traditional financial relationships have just broken down, like gold and treasuries.
Absolutely. They used to have this predictable inverse stance, right? One goes up, the other goes down. But the source argues that snapped Q1 2022.
Why then? What happened?
That's when, according to the source's interpretation, U.S. dollar assets got weaponized in the context of the Russia-Ukraine conflict. And the source does controversially claim that conflict started via Western proxy false flags. But the key financial point they make is that seizing sovereign reserves shattered the idea they were untouchable.
Introducing political confiscation risk.
Exactly, a huge new risk factor. And they say the link between gold and real interest rates also broke around the same time.
Why that one?
They blame something they call Yellenomics, basically criticizing the U.S. government's debt management as reckless short-term borrowing, not spreading maturities properly. The source says investors are rolling their eyes as the U.S. acts like a full banana republic, just piling up debt, benefiting, in their words, the Washington swamp and its plutocrats, with no clear plan to repay creditors with, real money.
So the takeaway is stark.
Mhm.
The U.S. Treasury, the ultimate safe asset, has lost its halo, at least in this source's view.
Yeah. For anyone not fully on board with what they call Uncle Sam's imperial financial soap opera, the whole risk-free idea is now, quote, a joke.
And that confiscation risk you mentioned, who is that most relevant for?
Particularly reserve managers outside the traditional Western alliance, they argue. Think Beijing, Riyadh, the Global South. The Russian reserve freeze was a massive wake-up call. Access to your treasuries now seems dependent on political loyalty to Washington. Frozen reserves are, practically speaking, gone.
Wow. Do they quantify this risk?
They try. They estimate investors, especially in the Global South, deserve maybe a 5% political risk premium on U.S. bonds now, meaning U.S. debt would need to yield closer to 10%, way above the current 4.5%, just to compete with physical gold once you adjust for that confiscation risk.
That's a huge gap. And this all came to a head in April 2025, according to the source. They described it pretty dramatically.
Drama worthy of reality TV, stocks, bonds, and the dollar all tanking together, which is rare. Hasn't happened since, what, 1977?
And while that chaos was happening, gold was.
Moonwalking to record highs is their phrase. Peaked around $3,500 an ounce on April 22nd. Now, it did dip sharply after that peak, triggering algorithmic selling. But crucially, the source highlights that dip was met by a huge wave of physical buying, particularly from China. It absorbed the selling pressure.
So the source's interpretation of that April event
Is that the market, spooked by the tariff uncertainty, started pricing in serious stagflation and recession. And in that scenario, the usual safe havens, treasuries, the dollar, they didn't act safe at all. They sold off together, behaving more like, quote, emerging markets running for the exits.
Okay, so if traditional safe havens are acting weirdly, who is buying gold amidst all this? The source draws a contrast here, right?
A fascinating one. They paint this picture where the figure they call the manipulator-in-chief is maybe, in their words, luring YOLO MAGA investors into crypto schemes. While central banks, especially in the Global South, are not buying into the digital snake oil. They know real money doesn't glitch or tweet.
So central banks are the big buyers.
They've been leading the charge, according to the source. Bought 244 metric tons in Q1 2025 alone. That's way up, 24% above the 5-year average. The source sees this as direct preparation for a more chaotic post-dollar world.
And there's a difference in how much gold different central banks hold.
Big time. Emerging markets are playing catch-up. China, they note, has less than 10% of reserves in gold. Compare that to the U.S., Germany, France, Italy, often 70% or more, a legacy, the source says, of the old gold standard days.
But some developed countries went the other way. The source calls out Canada.
Oh, yeah. Canada gets singled out, zero gold reserves, described quite sharply as forever run by WEF puppets and proudly allergic to hard money. Canada sold off its gold over decades, finishing in 2016, preferring supposedly more liquid assets like treasuries, betting on other people's paper, as the source puts it.
And the UK Gordon Brown sale comes up too.
Yeah, framed as a masterclass in financial self-sabotage, selling nearly 400 tons, over half their reserves, right at the 20-year market low, around 275 ounces. And they announced it in advance, hence the nickname Brown Bottom. Billions in potential value lost, and UK reserves are still relatively low.
So in contrast to that, the source sees Global South central banks doing the opposite.
Exactly. Quietly hoarding physical gold. Part of what the source calls a de-dollarization bid, trying to break free from Uncle Sam's economic clinginess. They mention Russia, China, India specifically boosting holdings, noting they're also major gold producers.
Interesting. So while some were selling, others were stacking. And it's not just central banks, there's a regulatory angle too, Basel III.
Right, the BIS Basel III endgame rules. Expected around July 1st, 2025, give or take delays. These rules are set to make physical gold a Tier 1 high-quality liquid asset HQLA for calculating bank capital.
Which the source finds pretty ironic, right? Gold, the barbarous relic.
Suddenly sitting alongside cash and government bonds in the top tier for capital requirements. Gets a 0% risk weight, meaning banks don't need to hold extra capital against it.
Are there catches? Nuances.
Yeah, the source includes clarifications likely from groups like the LBMA. So while it gets the 0% risk weight for capital and can be used as collateral, though, with a haircut like a 20% reduction in its value for lending purposes,
Okay.
it's not officially HQLA under the liquidity coverage ratio, the LCR, which is about short-term cash needs. And it needs stable funding under NSFR rules. And crucially, this only applies to physical bars. No paper gold wizardry. The source kind of sees this as bureaucratic hurdles, given gold's safe haven history.
Okay. And this regulatory shift ties into bullion banks, specialized players.
Exactly. Banks focus purely on physical metals, traditionally London, Zurich. But the source notes growth now in the US, Indonesia. They see this as hedging against the fiat circus, building real independence.
How does the source characterize them versus Wall Street?
As playing chess while Wall Street's still bluffing at poker, building real resilience versus Wall Street selling fairy tales. The source argues gold has consistently crushed U.S. banks in crises driven by uncertainty and tight credit.
And this demand for physical isn't just institutional. There's state-level action in the U.S.
Yeah, that's interesting. By 2025, they say 11 states declared gold and silver coins legal tender. Arizona, Texas, Utah led the way. Others, like Louisiana, dropped sales tax. Missouri, Oklahoma pushing to end capital gains tax on metals.
What does the source make of that?
Sees it as a growing grassroots desire for real money. Even if using gold coins day-to-day is impractical, like balancing your checkbook in a hurricane, it signals a fundamental shift in trust away from fiat currency.
Okay, speaking of fundamentals, the source takes a pretty sharp detour into politics and tech influence, doesn't it? Talking about the PayPal mafia.
Yeah, it's a strong critique. Names like Thiel, Musk, Hoffman, described as kingpins who rewired finance, hijacked the narrative, and now bankroll policy. Pretty pointed language.
And they draw a line between Thiel and the figure they call the vice premier-in-chief.
Yes, suggesting Thiel provided access and resources. They highlight Palantir's federal contract for a huge personal info database. The source quips, "Nothing says freedom like putting your entire life in a searchable file cabinet."
Ouch. And there was mention of legislation, too, the big, beautiful bill.
Right. They claim it blocks state AI regulation for a decade and funnels $500 million to agencies for security, which the source interprets as building a techno-surveillance state. Their conclusion is stark. The tech elite aren't disrupting the system anymore. They've bought it, coded it, and firewalled the rest of us out.
And the political analysis of the vice premier, how does the source frame that?
As a Trojan horse for the PayPal mafia, suggesting the allegiance shift after 2020 wasn't ideology, but leverage and pragmatism hitching fortunes to the MAGA machine.
They then connect this to historical transitions, like Bush-Gore before 9/11, hinting at future crises.
Exactly. Suggesting chaotic transitions create openings. They mention a specific appointment, Thomas Fugate, to a terrorism prevention hub, as an example of concerning moves during such times, though without much detail on why it's concerning in the source itself.
And the overall argument is that this embedded tech power structure is ready for the next crisis.
Ready to offer solutions, is how the source puts it. Solutions that likely involve more surveillance, digital ID systems, and algorithmic overlords, marketed, of course, as being for your safety.
Wow. Okay, to try and ground this, they bring in the fall of Rome. What's the parallel they draw?
Slow unraveling. Power grabs like Julius Caesar, civil wars, autocrats, inflation, and crucially, currency debasement.
The denarius losing its silver.
Dramatically, from over 50% silver down to just 0.2%. The source presents this as a symbol of an empire losing its grip on reality, on value itself.
And this all loops back to their main theme. Cycles are real.
Absolutely. Cycles are real. Wall Street's random walk is a fairy tale. Tanking the economy flips politics. Human nature doesn't change. And ignoring the business cycle is, historically, the root cause of governments being overthrown or splitting apart. They even reference things like Hammurabi's Code and biblical texts on economic structures as showing these patterns are ancient.
Okay, so that's a comprehensive picture of chaos and historical cycles from the source. Given all that, what's the actual survival strategy? How does "in chaos we trust, with gold we survive" translate into action?
Right. They summarize the new normal. Uncertainty is baseline. The old playbook is toast. Risk models are haywire. Treasuries are risky now. Even that huge leveraged basis trade. Not bulletproof, they warn. Deficits aren't shrinking. Recession whispers are growing.
And this is why gold shines, in their view.
Exactly. Its anti-fragile gets stronger from chaos. It's non-correlated. It shrugs off inflation and stagflation. And all that central bank buying acts as a kind of safety net, a put option under the price.
So what's the specific advice for right now, based on the newsletter date, June 13th, 2025?
They see the U.S. in an inflationary boom, but that S&P gold signal being below the 7-year average for months tells them an inflationary bust is coming much sooner than Wall Street pundits are eager to tell you. So stay calm, be disciplined, use data, ignore the hype.
What about the global picture?
Wobbling, largely due to the U.S. political circus, tariffs, EM feuds, banana republic antics, investors, consumers everywhere just holding onto their cash tighter.
And government debt. Any hope for cuts?
Zero expectation from the source, only creative accounting.
Inflation outlook.
Not cooling soon. They see tariffs and currency debasement as a favorite pastime for current and future presidents.
Plus geopolitical risks.
Yeah, Eastern Europe escalation, Middle East tensions. A perfect recipe, they say, for spiking oil prices, which could tip economies into an inflationary tailspin.
Okay, so given all that, what's the investment strategy they lay out?
It's pretty clear. First, steer clear of bonds, period.
Second.
Sell any equity rallies. Don't chase them.
Focus on.
Physical gold, the timeless wealth preserver, that's the core.
Because volatility is the norm now.
Default setting, they argue. Debt's piling up, trust is eroding. So real assets, physical gold, silver, commodities, are the only reliable hedge.
What about managing cash?
Short-dated, high-quality U.S. dollar bonds think under 12 months, and T-bills under 3 months. For income and flexibility, but keep it very short-term.
And if you absolutely have to own stocks?
Look for lean companies, low debt, strong cash flow, EPS, FCF. Companies that actually pay taxes, interestingly, and those that might benefit from trade wars or reindustrialization. Prioritize energy and commodity producers over consumer-focused stocks.
So it's a big shift in mindset needed.
Huge. From return on capital chasing growth to return of capital just making sure you get your money back. Especially with stagflation risks, they have a great line. Farewell, Goldilocks. Say hello to golden lots.
And they keep coming back to physical gold offering. Autonomy.
Actual autonomy, yeah. Freedom from the dollar, from fiat, from centralized systems. They contrast it sharply with things like Ripple or Tether, which they see as part of that politically exposed centralized circus. Gold is the original, the OG protector since 480 BC.
Okay, and the final summary from the source
is that history tells you what's coming. The U.S. economy booms, then busts. In these uncertain times, the Dow usually beats bonds long-term, energy producers beat consumers, and gold. Gold outshines bonds like a diva at a karaoke night.
Love the metaphors. And they stress the benefit of physical gold held privately.
Yes, precisely because it avoids compliance issues, digital IDs, counterparty risk, and reliance on potentially vulnerable centralized crypto platforms.
The ultimate takeaway, then, from the Macro Butler.
Gold matters. Yesterday, today, and especially tomorrow. That's their bottom line.
Okay, so wrapping up this deep dive into the Macro Butler's rather intense perspective, the core argument is we're not just in uncertain times, we're in genuinely chaotic ones, driven, they argue, by ignoring history's cycles.
Right, and this chaos is eroding trust in the traditional financial system, introducing really serious new risks like political confiscation, making old safe havens look shaky.
And in that environment, with debt soaring and trust falling, they point squarely at physical gold, as the enduring anti-fragile asset, the necessary tool for survival, hence the title. In chaos we trust, with gold we survive.
It's a compelling, if unsettling, argument they lay out.
Definitely. So maybe the final thought for you listening is this. If this source is even partly right, if those historical cycles are relentless, and if trust in our foundational financial institutions is genuinely declining, what does that fundamentally change about how you think about security, about value, about where you place your trust going forward?
And if the places you always thought were safe suddenly look less so, what unexpected assets or strategies might actually offer real, lasting stability in the years to come? Definitely something to chew on.